My name is Gary Dean, and I am work with sentiment timing with Woody Dorsey, and we started this 5 years ago, and really the way that everything has worked, it's kind of crazy how it did. I actually was I was a financial. I'm not sure what. Can you are you seeing? Can you see my screen, or is that? I'm not. I just see a little box on there. That's why I'm not sure what happened.
Yes, we can see your screen just
Okay,
fine.
all right. Sorry, the little box popped up. I wasn't sure if it shrunk. So basically, what happened was I was a financial advisor over at JB Hanauer, and I ended up reading Woody's book, Behavioral Trading, and I was part of his institutional service, and this is going back quite some time ago, and I was just pretty much amazed at how he was able to predict the when these markets were going to turn, and a lot of times they were months in advance. And after I had left JB Hanauer, I went on my own, and I was doing just a regular a newsletter for your technical stuff, your basic stuff. And I had ended up contacting Woody to see if he was able, if he was willing to switch over from an institutional type newsletter and bring it to a more of a retail part. And he agreed to it, and that's pretty much how we started Sentiment Timing. And we've been this is our 5th year we've been doing it, and things have been going really, really well. And what I want to do is just go over just really the different things that that we do, and it's going to be a lot different than the normal, say, information that normal people look at the market, because not a lot of people follow sentiment, and Woody's one of the few that have been tracking and charting sentiment for over 40 years. So with that, let me get started. So what our motto is: human error and market opportunities. And what we mean by that is that human beings in the markets are irrational, and there's always going to be an irrational element at work, and that's what creates market opportunities. Woody has proprietary database of stock market sentiment that is collected through daily polling process that is effectively filtered through thousands of sentiment sources, and from there he puts them into into charting. So what we really look for is, we're not the day-to-day sentiment, that doesn't really matter all that much. When you get somebody, say traders are 20% bullish or 70% bullish, those aren't really things that are going to turn the market. The things that turn the market are when you get your extreme bullish or bearish readings, and those come when you're in the 90s or you're at it below, say, 5% bullish. And when you get those readings, typically those are what you're going to see your market tops and bottoms at the sentiment extremes. And it's not a trading tool. What it is, it's an indicator, and we'll go through that a little bit more in the presentation. But the big thing that really traders want is, you want to make better trading decisions. And there's, like I said, I was a technical analysis person. I know all your Elliott wave stuff. I know your Fibonacci retracements, patterns, and what do. But the problem with that is, everybody knows them. And if everybody's trading off the same thing, the market, it's a zero-sum thing. There has to be a buyer for every seller, and there has to be a seller for every buyer. So one person's going to be right and one's going to be wrong. And what we're trying to do is give ourselves better trading decisions. And whether you're a day trader or a swing trader or an investor, the key to making money is putting the odds on your side. So you want to use instruments that not a lot of people use, and one of those is the sentiment. Not a lot of people understand it. Not a lot of people know how to trade it. And what, like I said, Woody's one of the few people in the world that actually does tracking of sentiment, that it's the same group that are doing these sentiment things, and they break out into say thousands of different sentiment polls that go out. So nobody's going to be 100% correct all of the time, and anybody that says they are, you probably want to run from them. The markets, they can be predicted, especially on a short-term basis with a high degree of accuracy, and there's a code that it follows, but it's always changing, and that's what Woody Dorsey has been doing for really the past 40 years, is mastering this code, and a lot of it has to do with just cycles through sentiment, through price patterns, through time, and from that, what happens is we're able to project when the reversal is expected to come. And what we really do is we don't give buy or sell signals. We give it, is it safe to buy? Should you be shorting the market, or should you stay neutral? And those are really your three options that you have as a trader. You're either bullish on the market and you're buying, or you're bearish on the market and you're shorting, or there's really nothing that's showing up and you just want to stay neutral. And cash is a position in this market. And the one thing that I find in my many years of doing this is that everybody wants to be in a trade every day. And when you do that and you force feed something that's not there, your odds of losing go up, because it's almost like going to a casino. The ones that lose, they don't invite you back and give you your free dinners or your free nights there. It's the ones that win that they invite you over, because they know that the odds are that you're going to lose. The same is with trading. If you feel like you need to be in this market every single minute, every single day, and you're going to watch every tick of it, you're going to make decisions that are not rational, and that's, as I read before, the market's irrational, and that's what exposes the opportunities that we have, and that's how we make money. And you have to be patient with this market and let things come to you and have everything lined up. So our market timing matrix, or our predictive analytics, what we do when you're using the say the predictive analytics, there's three components to this. It's time, sentiment, and price. And as I said, there's you want to follow things that not everybody is following, and that's going to give you the trading advantage over the majority, because the ones that are just using your regular technical analysis, like I was, you find out that you get, you have everything in place. You have your sell signals on the indicators, wave structures are there, we're running into resistance or support, and the market keeps going in that direction. So technicals, where that falls short is you don't know how people are actually feeling about the market at that time, and that's where the sentiment pops in. And then you also have the time part, and that is when the market is expected to make the reversal. So again, we have the time piece. That's when the market's going to reverse and trend. Sentiment is a confirmation of the time, because as I mentioned before, the majorities are going to always be wrong, and you'll see them on the sentiment charts that they really are. When everybody jumps on one side, it's usually that's the tipping point, and when the market is going to reverse. But when we have a time period that either we're expecting a top or a bottom, and you have sentiment that's supporting it, whether we're looking for a low and we have sentiment readings that are 0% bullish, meaning nobody's bullish on the market, that's usually when lows come in. When we're looking for a top, we're usually not going to see that top come into play until we see 99, 100% people bullish. And then all you do is you have your price, and that's your technical analysis, your divergence, support, resistance. And on top of that, it's also, say, the trade trigger. And I'll go over that a little bit more in the presentation. So Woody Dorsey has been, USA Today has actually called him the stock shrink, and he's been interviewed on just about every financial news station. Like I said, he's been doing this for over 40 years for some of the largest financial institutions in the world, and they've depended on his his market timing views, the sentiment, and everything that he provides. And he's been in the business for 40 years. He's the best-selling author of behavioral trading. That's where I had read the book and decided to contact him. And he's considered by many on Wall Street as one of the best market timers in the world. And he's been featured CNBC, Barron's, Smart Money, Squawk Box, Bloomberg. So he's been around. People know who he is, and people have been following for 40 years. So what is sentiment? A lot of people don't get it. They'll look on, because there's sites out there that have sentiment readings, but the problem is that if you're not doing the same format of coming up with your sentiment numbers, they're skewed. And that's really what a lot of these websites do. It's just people out of the blue logging in saying whether they're bullish or bearish. And sometimes they could be useful, but when you have a system that's been in place for 40 years, that is the type of system. Like I said, he's one of the I think been following and charting sentiment, one of the longest that I know of, at least. But sentiment is how traders feel about the stock market. So most technical indicators are derived by price, and sentiment is measured by human emotions about the market. And if you actually take a step back and think about it, human emotions are what moves the market. There is nothing else, because if you feel that the market is going to go up, you're going to be buying it. If you feel that the market is going to go down, you're going to be shorting it or selling. So emotions controls everything. Price drives stuff up, but it's the actual emotional trade that is producing the price movement. So extreme sentiment doesn't always mean that price has to reverse there, and it's an indicator, but it's not something that you can trade alone. It's something that has to be interpreted, and along with price and how things are going. Like I said, we match up time, sentiment, and then technical analysis. So tracking both intermediate and shorter term sentiments, which I'll show you in the presentations how they go, offers a clearer view of when price reversal may be near. So let's take a look at some other things here. Sentiment is considered the missing link, because, like I said, not a lot of people know about sentiment. They don't know how to actually trade it, what it means. A lot of people will look at it and say, oh, everybody's bullish on the market, we have to short it, or everybody's bearish on the market, we have to go long. And I'll show you moving forward that that's not always the case, and it has to be matched up with other things. So sentiment is only data. It's not it's one of the components of the market equation, but it's just data. That's all it is. It's how people are feeling about the market. So Woody's been collecting his sentiment data for over 40 years, and it shouldn't be confused with other sentiment stuff out there. I know CNN has a bull bear poll, but again, it's nothing like what is done through the sentiment polling that Woody does. So it's not a trading system. It's a powerful diagnosis of the tool that not many traders understand. And again, that goes back to that point where you don't want to be trading what everybody else is trading, because the market is a zero-sum game, and if everybody is trading one system and everybody's looking up, there's not going to be anybody to sell to or to buy from. So you always have to have one or the other, and you want to use these tools that not a lot of people understand or how they use. So this is kind of just an outline of the investor sentiment data polling, and it just all goes from the sentiment database to your stockbrokers to everything that goes around. It all comes into the database, and from here, this is how they're charted and how it's shown to our subscribers on it. It's not showing you the sentiment data on a day-to-day basis, because it's not useful. We don't want anybody to make any rash decisions, because if they see 78% bullish reading or a 15% bullish reading. Everything has to be interpreted, and that's where you have Woody that's been doing this for 40 years that is able to help you out. So here's an example of this is one of our most recent sentiment readings that we had, and you can see as we made this top here, this is what I'm talking about, where the majority are going to be wrong. And if you notice, each one of these where we had 93%, 98%, 99%, that means that not this many, this is the percentage of the polling that came through this saying that they were bullish or bearish on the market. So when we were here, we made it to 93%, and this is off of the lows where everybody was bearish on the market, everybody was selling it, and it was a perfect buying opportunity. And we actually, I'll show you in this that this was actually marked as the low on it. But then once everybody got bullish on the market, we saw the market start dropping again. And this is what I mean by the majority is going to be wrong all the time. And once you get this 0%, 1% bullish reading, you don't want to be shorting the market down here. It's the odds aren't in your favor. For if you got it on the first try, like something like here where we had an 8% bullish reading, this was after a 99% bullish reading. So this was a confirmation that the market was heading down. But once we got to where everybody was bearish on the market, this is not where you want to be shorting. You want to be shorting when it's up here and we're running into a turn date and we have a technical reason to be able to short. And again, I'll show you how it plays out in the in the coming slides. But just notice how everybody is bullish on the market as it's going up, and they're bearish on the market when it's going down. And when we get to the extremes, that is typically when we are going to get a market reversal. So the high sentiment and the low sentiment numbers, even though they're not a trading trigger, they're a warning sign as well. As when you have a 99% bullish reading, you don't want to be jumping on the bandwagon with everybody on the long side, especially when there's a turn date coming, and the same thing goes on the downside. So that's the short term sentiment readings that we provide, and this is a longer term. So this is a 10-day moving average of the sentiment that we follow. And notice when we're up here, this is a great tool for divergences. And what I mean by that is, and when we had this run in going into the end of 2017 into 2018, notice what happened with the longer term sentiment readings. So like I said, we don't show the daily readings, but only the extremes on it. But when you get those daily readings that are coming through, what happens is it's pulling down the overall the longer term sentiment readings. And from there, this is what we call a bearish divergence, where sentiment was moving down on a daily basis, but yet we are getting extremes on here on quick pops on it, but it was still moving the moving average down on the sentiment. And from there, we know what happened. We saw the S&P drop, I think it was 300 or 400 points. I don't have it in front of me right now, but this was a fantastic trade, and this was exactly when we were anticipating that a top was going to come in. And again, I'll show you that in the near future. Predictive analytics and timing profiles. So what do we mean by predictive analytics? And basically, it's just it's a use of many techniques to analyze current and past data to make predictions about the future. And like I said, Woody's been doing this for 40 years. He knows when, how when sentiment gets to at the certain levels, say on a longer term period, how long it's going to take before they burn off the extreme bearish sentiment and then come into a bullish sentiment. And from there, he's able to predict when these markets are going to reverse. And like I said, a lot of times they're weeks and sometimes months into advance. And from the sentiment, there's also fractal patterns, and that's what I follow on from a technical basis. I look at previous patterns in the past and see, they're not going to follow them exactly, but what it is, it's a
it gives you a glimpse of what could play out in the future. And when you have the time part of it, and then you have sentiment that's backing it out, it makes it a very powerful tool. So you have fractal time sequences. That's Woody, that is predicting when these markets are going to reverse. You have the sentiment cycles, and then we have our fractal patterns as well as regular technical analysis. And from there, you're able to predict when the S&P 500 is scheduled to take place, a reversal is scheduled to take place. Now, Woody's timing profiles, so when the S&P 500 will reverse, are supported with the sentiment and technical indicators, as I just mentioned. And sentiment extremes will almost always be seen at the market tops and bottoms, but it's not a trade signal. But like I said, if we're expecting some type of top to come in place, and it's coming into that time period, and from there we see a 99% bullish reading and then a 98% bullish reading, that's supporting that reversal, because everybody is jumping on the bullish side and only looking up. And if from a technical aspect of it, if we look at it and we see that there's some type of pattern in place, or we have bearish divergences, all we do is wait for a trade signal to pop up through price, and from there you're shorting the market near the top and you're buying the market near the bottom. And if you've noticed in this market, it's really these huge moves are happening in 3 to 5 day time periods, and it's been one of the best trading years that I've had. Just our service alone has had, because one of the big things that we really need as a service is volatility, because if there's no volatility, then there's really not much to even report, because when there's no volatility, the market's just grinding higher. It's all a matter of, if there's volatility, that's what messes a lot of regular technical analysis systems up. It messes up a lot of traders because they can become complacent. When volatility comes into place, for us, it's a dream come true, because our when we're expecting a top to take place, they seem to fall right in line with it. When sentiment hits extremes, that's when reversals hit, and a lot of times they happen right at our target areas. So let's take a look at some. I'm going to go through some just old reports and bring them up into our new reports right now, and this is going to give you a pretty good idea as far as how our predictive analysis works and our analytics, as well as our fractal patterns. So this is on August 4th, 2015. It's just to show you that this isn't something that just happened, overnight. We've been making these calls the whole time, and this is what Woody had put in here, is that there's a potential trading target or sell zone due on August 14th to the 21st, so almost 2 weeks ahead of time, and he's calling it the kill zone. So if we go and we take a look at what took place, and you notice that everybody's bullish on this market here, you saw 91, 94% bullish, and it was running right into that kill zone period. And if we take a look, this is when it was reported that he was expecting the kill zone. Here's that time period. We knew we had everybody bullish on the market. We were running right into the time zone, and this is what happened. So our, myself as well as our subscribers knew almost 2 weeks in advance that this was coming. And this is predictive analytics, and this is what we're talking about, how knowing in advance and being able to adjust your portfolios properly, you make a lot of money in a really, really short amount of time. So this is going now, this is the next year, this is June 2nd, and the market was kind of just doing whatever it was. But what he had said was that there's a black hole environment coming in August. So again, we're in June. We had 2 months away from that, and he was looking for the black hole. So let's go. Here's our June, here's our August right here. Notice how everybody is bullish on this market here. Just the series of them. You have 98, 92, 94, 93, 97. So everybody's bullish on the market, but notice what the 10-day moving average is doing. It's going down, it's diverging from here. So we had our time period in August that he was looking for. We know sentiment is backing it, and if we take a look, here's the June 2nd, that's a report that he was looking for the August kill zone, And from there, we saw the S&P have the bearish divergence. And from there, here's our sell trigger. Our short trigger was once it took out this low right here, and you put your stop right above the previous highs. So we got in, didn't get stopped, and it was a 100-point move to the downside. Typically, they move it. Now, there wasn't really a whole lot of volatility in the market back then, but it was still a 100-point move to the downside that was predicted 2 months in advance. And again, that's what this predictive analytics does, and how Woody, how knowing what to do ahead of time, it keeps your emotions intact, because everybody was waiting for the breakout here, and we were, the warning was that we had bearish divergences. We were heading into a time period to expect a top, and as well as that, we had sentiment that was at extremes. And once we made this low and everybody started buying here, we saw another big low hit, and this was the time period that we were looking for the low. And as you know, we had a massive move to the upside. So let's move this in a little bit closer here. And this is our, this is just in January 2018. And what he was saying is that and this is something that if you guys want this, I'll give you my email. You can send me an email and I'll send you. But this is what Woody had put out as far as with the stock bond ratio, and what his call is that there's going to be a great correction into 2021. And it's going to be choppy into that, because if when the market goes down, you get massive moves both on the upside as well as the downside. So if this stands to be true, which I have no reason to doubt it's not, people that are expecting this volatility to vanish are going to be in for a big surprise. And it's something, like I said, I've made more money this year than I've made in any year because of the volatility that's come into play. But this is now this is kind of a reverse of what we were talking about with the predictive analytics, where this is when a top was supposed to be, and a lot of times that's when the market was rising. And I'll just go back and show you on this. So a lot of times we're predicting a top as the market's rising, but in this particular pattern, he was looking for a low that was due on February 13th to the 17th. Now, why is that hard to believe on that? Well, the market at the time was moving up, so we weren't looking for a top. It was predicting a low. So what does that actually mean if you take a step back? If there's a low that's due on February 13th to the 17th, and everybody's bullish on this market and we're heading up, it means that you don't want to be jumping on the bullish side here, because guess what? We're going to get that drop that's going to be coming. And what we were really looking for was some type of price trigger. And again, here it was. We had bearish divergences in place. The low date was predicted to come on February 13th to the 17th. And if you notice, once we got the short trigger, which we got on this move right here, the S&P dropped. I think this was the 400-point drop on this, and it came right within our time period. So February 13th to the 17th, that was that was given here, and from this period here, it actually came. We had a 0% bullish reading that was on February 9th, and we actually sent out an email saying that there's a very good odds through Woody's research that he's done in all his years that this was the actual low, and don't be short this market anymore. And as you know, the S&P rallied some 200 points off of there. So from here, we were looking for the low, and everybody was bullish on the market, and this is what was the result in it. And when everybody was bearish on this market, guess what? We had the big rise to the upside, and that's really what. The way to make money in this market is being able to see what is going to be coming in the future. Because if you're a reactive trader, what happens is you become an emotional trader, because usually you're missing the first big move that's taking place, and then you're jumping in as the market's either going to drop or it's going to rally. And from there you're getting frustrated, and that's why people do not like volatility in the market. But if you're able to see how traders are feeling about the market, and then know when the market is scheduled to either make a low, if we're looking for a low as it's going up, it doesn't mean that you want to be buying this market right here. You want to be looking for a short trigger, which we got, and like I said, it was a fantastic trade. But this is what I mean by positioning your portfolios ahead of a move, because most people, this is when they started looking to short, when we got this move here, and from there they washed out on this one as we went down again, and everybody started shorting again and was only looking lower. And then this happened. So if you know what's going to be playing out ahead of time, you're able to control your emotions, you're able to position your portfolios. And there's times when the market gets tricky, and guess what? You just stay out. That's what I was saying, where you really have three options in this market. That's you're bullish and you're buying, bearish and you're shorting, or neutral and doing nothing. And there's some of these dates that aren't going to play out. But when you're able to use the three type matrix that I was talking about, where if we don't get say on a specific date a low or a high, most likely price is not going to give you any kind of buy or sell trigger like we have up here. We're not going to make that lower low that's going to do the short trigger or break through this resistance to give us a long trigger. So it's one of those things where we may have extreme sentiment readings, we may have a turn date that came and go, but price didn't give us any reason to make a trade. And when you have those three things that you're able to dissect what you should be doing, it really it helps things out a lot. So let me this is just, I want to go over some regular technical analysis, and really what that means is technical divergences are when you have your if you have your technical indicators that if you're looking for a top, if they're making lower if they're making lower highs as price is making a higher high, that's considered a bearish divergence. Vice versa, if it's price is going down and your technical divergences are moving making higher lows, that's a bullish divergence. And then that's a combination of using the sentiment as well as the time periods, because if you have these technical divergences in place, then it's supporting that reversal is going to be taking place. And then you want to just take a look at what the fractal patterns are. Is there a target in place? Where's your resistance? What areas do you want to start taking profits? And that's something that I do all the time. I don't go all in at one place and then go all out in another. What I usually do is scale in a little bit, and then as the market's moving in my direction, scale out a little bit and leave a little bit for that home run trade where things are just going to go a little bit crazy. And that's actually taking place right now, which I'll show you in a little while. But you hold on to a little bit, and as we approach the turn date, which we have one that's coming, you're only going to have a very, very small position that we've been long since 26-24. That was our long trigger, but right now it's scaling out because we have a turn date that's coming. We had most likely after today, if the markets stay at what they're doing, then what's going to happen is we are going to we're going to have an extreme bullish reading. But right now we would wait for price to trigger a short position, and I'm going to just run with my long position until I'm taken out of it, and then from there I'll wait for a short position to get triggered, because the market has really just started making its move, and there's a few things that are telling me to be a little cautious about the short side, which I'll show you guys in a little bit. But so one of the things that I really pound the table on with subscribers and even people that have questions and stuff is, you have your Elliott wave, which I know pretty well. I don't know all the little kind of zigzags and stuff like that, but how do you know, if you're an Elliott wave trader, how do you know when a pattern is going to extend if you don't know when you don't have the when in the equation? And that's one of the biggest things that I see happen with Elliott wave traders is, oh, this wave is extending. Well, it's really not extending because we weren't expecting a top or a bottom to hit until this particular time period. But that's what catches them off guard enough. And the same thing goes with the technical traders. You have bullish or bearish divergences in place. You're at support, and you're looking to make your trade, and you make it, and you find the market continue in that same direction. And the biggest thing is you didn't know when to expect a reversal. But when you add the when into it, and you have the combination of the, you know, sentiment as well as these technical divergences, it really makes trades, it puts the odds on your side. So just to show you here, this was when we were, you know, the low period that we were looking, and one of the patterns that I picked up on was this inverted head and shoulders pattern. And here's what these targets have been in place for quite some time here. So we hit one of them today, 2710. If we see the S&P break through that, my next stop is going to be this 2740, or they're going to come and close this gap here. And if we, in right now, I took half my position off on the long side from the 2624. And now if we get up to this 2640 area, what I'm going to do is take another quarter off and hold it if we get up to 2800. And then if I get stopped out on the way, then I know that I'm going to be switching to the short side. And why? Because we have the when. We know that we have a top date that's been in place for over the last 3 weeks. So we're running into that time period. Sentiment is going to be in that in the extreme bullish readings, and we're running into resistance zones. So this is, you know, that's why I'd rather just run with a small long position until I'm stopped out, and then wait for a sell trigger to go short. And if the sell trigger may not come into play, and we may just continue to run higher. That's one of the, you know, the things that's good about using the 3 method on it. So one of the things that I'd put is the right now, the advanced decline. I'm not sure if anybody follows it, but it's a great tool to follow. And that's actually making new highs. And I don't know if I don't think I have the chart. I don't, hang on one second. But anyway, the advanced decline is making new highs. So what I just put in today's report is, this has always been my wave structure, is that we made this wave 3 here. This is a 4, and now we're going to come up and make a wave 5. So if the advanced decline line is right, then we, you know, the expected top date that we have may get blown right through, and that's fine. That we're, like I said, we're not going, these dates aren't going to be right 100% of the time. They're right, I would say 85% of the time, maybe even 90%. But if price does not trigger anything, then you just keep running with the side that it's on until we get, you know, some kind of move. But as we start approaching resistance and we start getting some sell signals, then you really just move to cash and you wait for the sell signal to trigger. And until then, you know, I'd rather be wrong and long as the market's moving up than shorting down here. And if it continues up, then it's pain. So you know, these are the patterns that I have in play. And if it doesn't decide to go up here, then what happens is this is just going to be your it's an ABC move, and your wave 4 is coming down here. But as I'm showing you this, I want to give you one quick thing, and this is the weekly chart. So this one was the daily chart where I said we have the 3, 4, and possibly wave 5. So is that a reason to get really bullish on this market? And this is the reason why you want to be really careful, is because once this wave 5 is done, it's going to be the top of the weekly chart, and these are the targets on the downside. And remember what Woody had said in the stock bond ratio, that we could be in a decline into 2021. And if that's the case, do not be surprised to see the S&P trading below 2,000. This is an actual target based on Elliott wave. So it's nothing that I trade off of, but it's just something I like to take a look at, and especially when it's matching up with the stock bond ratio that Woody is talking about. And like I said, we have some turn dates that are going to be approaching really quick. So one thing I want to just let you know, we don't really offer free trials, but what I want to do, because we're presenting here, is you know, if you'd like to know, to look at the markets in a different way, and knowing kind of weeks and sometimes months in advance when to expect the S&P to reverse through predictive analytics, sentiment, technical analysis, we are offering a 2-week trial. Now, what you need to do is go to sentimenttiming.com, go into the join tab here, and then it's going to ask you to put in your information and the coupon code, 14-day trial. From there, you don't get charged anything. You'll be able to test us out for a couple weeks. And I think when you start seeing some of the information that you're going to be gathering, you are going to enjoy things very much and not want to cancel.